Hello everyone, welcome back to Macroeconomics. So today we are moving to this new chapter to talk about another policy, which is the monetary policy, which is the policy discussions part two. So in this chapter, we are going to go over some of this key concept of the policy. So we will talk about what is a monetary policy, what is the policy goal for a monetary policy, and we will try to use the money markets to explain the effects of monetary policy by using the ATS model. But of course, before we jump into the model, we have to understand the money markets a little bit. So there's a section for that. And we will have the second videos to talk about the restrictions or maybe the limitations of the monetary policy and also how the monetary policy actually works and what kind of policy targets that we set in the economy so that we can actually make a more stabilized short-run economy performance. So the monetary policy, it's basically a policy by the Fed. So it usually refers to the actions of the Fed taking to manage the monetary policy targets. So in the past, there were two very popular policy targets that we are trying to meet. One is the money supply and the other one is interest rates. In the recent years, we actually switched the targets to another variable, and we'll talk about a little bit later. However, in order to achieve those monetary policy targets, the ultimate goals for the policy, it's pretty similar to the physical policy. So the monetary policy goals has couples. Number one, price stability. We are trying to stabilize the prices in the economy so that people will not be able to caught out of guard. They will know what's coming. They can expect what the inflation will be in the future, and we're trying to control that and maintain that levels so that people expectation will not be going out of hand. And second of all, of course, very similar to the physical policy, we are trying to use the policy to ensure that the economy will have high employment so that people will get the jobs and incomes. And also, one particular goal for having the monetary policy is to provide a stability of the financial markets and institutions. As we discussed in the previous chapters, we found out that the use of the financial market is very, very important in our economy because it helps to reduce the risk for saving the money in the economy, and also it helps to allocate the fundings from one agent to another agent a lot more efficiently and a lot more quicker without the transition costs for making the exchange in the loanable fund markets. So that's why it's very important for the governments to maintain the stabilities of this financial markets to make sure the flows of money can go from the households to the hands of the firms and businesses so that they can invest in the future economy. Of course, the ultimate goals for any policy is to drive the economic growth of the society so that everyone will have an improved life in the future. If we look at the inflation rate history in the United States, as you can see, there are some periods where the United States government it's not doing they were not very doing a very good job to achieve the goal of price stability. So as you can see from this graph, there is a period from 1967 to 1985, around that period. You can actually see how fluctuates the inflations are in the this period. You might actually see the inflation jump almost up to 15% to the peak, and sometime will go down to 2% or maybe even lower in some periods. Well, again, we have talked about the social costs for inflations, especially the unanticipated inflations, the unexpected ones. This unexpected inflations or fluctuations in prices, it's going to cost the firms and households not able to make a correct economic decisions because it will cause the firm to hesitate how much they will charge the products in the economy. And also it will hesitate the households to make consumptions of the goods so that they can actually maximize the value of the money because they don't know when they should buy the goods would be a good time. When inflation go up very high in one day and then drops immediately to the next day, they have to always think about, well, when they should make a purchase. And both firms and households cannot make a correct economic decisions. That means we are basically slowing down the exchange in the economy. So we are basically reducing the level of activities, economic activities in the economy. So that's why we believe one of the main goals to the monetary policy is to try to provide that stabilities of prices. Well, after that period, as you can see, well, from the year of 1992 all the way down to the recent years in the graph, 2012, we have experienced relatively stable price levels in the economy, which usually will have the price level range from 1 to 3 or maybe 4% every years in these periods. Which is a success of the monetary policy by the Feds. So it's pretty obvious how well the Fed has been doing their jobs after that period of 1992. And we will talk about the Great Recession's periods where you see the overall price level actually drops below 0% inflation rates. So in order to study the monetary policy, well, one particular tools that we have to understand is the use of money markets. We have to first understand how the money market works in order to understand how the policy actually can be effective to our economy. So we will first learn about why people want to hold money. And in this particular case, it's linked to our previous lecture when we talk about the use of money. So as most of you guys understand now, the money, it's basically demanded in the economy because we need the money to make transactions in the economy. We have to use money to buy goods and services. So we also learned about in the loan fund markets where sometimes households can actually not spend the money and save the money in the economy so that they can earn interest in returns. So now the question is, if our ultimate goal is to maximize our wealth in the economy, why don't we, every time in the economy we earn some income, we just save it all, or maybe we loan it out to earn interest payments so that we can get even more in the future? So why people actually want to hold money? And in this particular case, we also want to refer the term money here as the liquid assets in the economy. And what that means is basically what we define as M1 in the previous chapter. When we define the quantity of money, right, the aggregates, monetary aggregates in the economy, we define the money into two terms. Either it belongs to M1 or it could belongs to M2. So M1, it's basically the most liquid forms of money in the economy. And we want to study why people want to hold M1 but not having all the assets stored into M2 so that they can maximize the wealth in the future. So of course there are two reasons why people want to hold on to this liquid assets in their life. Well, the number one reasons we have talked about, people needs to make transactions. So people needs the liquid assets to buy goods and services. You cannot always store your money into some forms of investments like long-term saving account, a CD account. You cannot store all your money into a stock market. You cannot store all your money into maybe buying a treasury bills because the fact that, well, you need some of this money for yourself to buy goods and services in your life. Well, another reasons why people want to hold these liquid assets, it's because of speculations. So people sometimes needs to hold some forms of liquid assets just in case if something happened in the life. So for instance, if one day you got into an accident, you actually go to the hospital and want some treatments to heal your injuries. And obviously, the hospital is going to ask you to pay for the service. If you do not have any liquid forms of assets, unfortunately, at that point of time, you won't be able to pay for those services that you need. So again, mainly in our economy, we want to hold this liquid assets because we know we sometime actually needs to use it for whatever occasion there is in the economy. So if we know that there is a demand for this liquid assets, then obviously we can apply the concept of supply and demand and create a market. So money, it's basically a commodity that we are trying to demand in the economy. So the choice of money basically is coming from these two. We are whether having that money we have and store it into a liquid forms, which is the liquid assets that we use to buy goods and services, and we call this a money in our models. And we can also have a choice to actually store this wealth or assets into a non-liquid assets, which is something that we store into maybe a CD account, or maybe buying a stocks, or maybe buying a corporate bonds to actually gain values for the future periods. So in this case, for example, you can think about you have $100 incomes this month, and you're always making a choice. You are trying to tell yourself, maybe I will split this money into two. Maybe 70% of the income, let's say $70, will be saved into a liquid assets, let's say put into a checking account so that you can use it anytime you want. And you will always save 30% of your assets into maybe your CD accounts so that you can earn interest in the future. And that split's basically telling us that, well, you as an individual person will have 70% of the wealth or assets stored into a liquid assets form, and 30% of the assets will be stored into a non-liquid assets form, which you cannot get access to into buying goods and services immediately. Now, what makes you to determine you would store 30% of your wealth into a non-liquid assets, and what makes you think that 70% would be a good amount of money to store into a liquid forms? And the ultimate choice here is based on the returns for storing your money into a non-liquid assets. Or on the other hand, I can refer to the costs for not storing your money into a liquid assets form. So interest rate basically is the cost for you to giving up this saving into a non-liquid forms. If you think about this a little bit on your personal experience, let's suppose a bank actually offer you a 10% returns of interest payments if you store your money into this special saving account. And if you choose not to save your money into this special saving account to earn a 10 interest rates in returns, obviously you're giving up the returns in the future. So the interest rate is kind of serving like an opportunity cost for a person to hold their assets into a liquid forms in general. So the higher the interest being offered, the higher the cost you have to give up in order to keep your money into a liquid forms. So that's why we know there is a relationship between interest rates and the amounts, the quantity of liquid assets in the economy. So generally speaking, banks actually aggregate all this deposit and loan fund out to earn interest. The interest is paid on the assets in non-liquid forms, and there is a continuum of the liquidity. So interest rate is higher for less liquid fundings. So in this case, well, we are basically explaining how the way interest rate is being determined and how it determines also the amounts of liquidity fundings in the economy. So the interest rate is not a fixed number that we see in our economy, as you can imagine. You will see different interest rates in the economy. So for instance, if you go to a bank and you try to get a long-term saving account, let's say a CD account, that you have to store the money there for 3 months, well, the bank will tell you one interest rate, and then some other CD account that you have seen in the economy. Let's say there is another bank offer a 6-month CD account. Well, comparing the 3-month CD account and 6-month CD account, obviously you will expect to have a different interest rate to pay on your assets so that you can get either more or less in the future. Well, how is this interest rate linked to the length of the CD account? Well, here's the intuitive sense. The longer that you are going to give up your funding so that you cannot use it, the more you should actually get back in the future. So that means when you are storing your money into a 6-month CD account, obviously you will expect to have more in returns as compared to you are saving your money into a 3-month CD account. The reason is because you have to give up the rights to use your funding for longer terms. It makes it more non-liquid in the economy. So we say the liquidities, or maybe funding, has a continuum here. Basically, it means, well, there are different products in the economy where you can store your funding or assets, and there are different liquidities, right? Spectrums of this for your choice to store your assets. So you have a choice to buy a 3-month CD account for interest that's paid you very low. You have a higher terms, let's say a 6-month CD account, or maybe buying a 1-year corporate bonds, or maybe buying a 10 years federal bonds, or maybe a 30 years federal bills in returns, which only 30 years later. So obviously, all of these are basically a different level of liquidity of the funding. The longer you have to give up, the more non-liquid it would be for your assets. So the interest rate, it's basically related to the level of liquidity of the funding. The more non-liquid assets that you are getting into, the higher interest payments or the higher interest rates will be attached with that types of funding. And the lower non-liquids, or maybe I would say, well, the more liquid forms of fundings that you are actually engaged in the economy, the lower interest rates that you will expect to return. So consider the interest rates. Again, it's basically a premiums that we see for a lower liquidities of your funding or your assets in your life. So the longer you give up, the higher interest you will get in returns, and obviously the less you will be able to get in returns in the future. So you are always choosing how long you are going to give up your funding, how non-liquid it is. You want to actually store your assets into this investment tool in the markets. So at the end, if we know interest rate, it's basically serving as a opportunity cost for making a decisions of liquid assets, then we can plot those relationships. And this is basically the way how we conceptualize the demand for money in the economy. Again, we are referring to the term money here, not every single dollar you have in your life. We are referring the term money here as the forms of liquid assets, M1, in the economy. So in the economy settings, the higher the interest rate it is, the lower the quantity demand for money will be. So that means at a higher interest rate, people do not want to store their money into a liquid form. They don't want to keep cash. They want to actually put their money into a non-liquid forms to earn interest payments. And the reason is because at a higher interest rate, people are willing to get more in return for the future by storing the money now, as compared to if they are facing a lower interest rate, then people will not have any interest to save the money into a non-liquid form because, well, the non-liquid assets do not provide the returns that it's good enough for us to get in the future. So we would rather keep the money into a liquid form so that we can use it anytime we want. We are not worried about losing a lot when the interest rate is low. So in this case, the quantity demand for liquid assets or money will be relatively high. And this downward sloping demand curve basically demonstrates the relationship between interest rates and the quantity demand for money. Well, what are the shifting factors in this quantity demand study? Well, number one, the aggregate outputs and aggregate incomes, which is the same thing. The amounts of buying and selling of goods and the additional buying, and selling increases the demand for money as the medium of exchange. So you can imagine how the aggregate demands for money will increase, keeping the same interest rates. So for example, if you think about the economy only produced 10 cars, and each car actually costs $100 to buy. So to buy all the products or all the produced car in the economy, well, the people in this economy will only need to earn a aggregate incomes of 10 car times $100, which is $1,000. So as long as the population actually earn $1,000, they have $1,000 of cash, they can actually buy all 10 cars in the economy. Now let's think about a second year. Let's suppose the economy actually produced 20 cars, and each car is $100. When there is a boost in aggregate outputs, when the economy producing more goods and services, well, in order to make all the transactions in the economy, in order to buy up all 20 cars in the economy, now the economy will need how much cash? Well, we have 20 cars, and each car is $100. So in total, the economy will need to have a liquid assets of $2,000 to buy up all 20 cars in the economy. So as you can see here, well, when the aggregate outputs or aggregate incomes increase in the economy, the demand for money will increase. And that's why the aggregate, money demands in our model will shift to the right. Well, another shifters, it's basically the other alternative change in the economy, which is the price level. So same analogy that we use, right? We have the first year where we produce 10 cars and each car is $100. And to buy up all the goods in the economy is basically $1,000 in the first year. And let's suppose in the second year we still produce 10 cars, but the price of the car actually went up. So each car now is $200. So when we actually have an economy where we produce 10 cars and each car is $200, to make all the transactions in the economy to buy all 10 cars, we'll have the aggregate liquid assets of $2,000, again doubled, right, to making all the transactions in the economy. So when price level goes up, the demand for money will also goes up in the economy in order to buy up all the transactions that's possible in the economy. So those are the two common shifters in the study of money demand. Well, what about the money supply? Well, fortunately, the study of money supply is not difficult at all, at least in the United States. In the United States, the money supply, it's basically a vertical curve like this one. There's a fixed amount of money that is being supplied in the economy. The supply for money is fixed. At any given amount of time, there is amount of liquid assets it's being offered in the economy. The sum of these liquid assets form the money supplied in the economy. And very important, you have to note the total amount of money in our circulations is not determined by the markets. we do not have the market to supply the money. However, there is one central agent in our economy that determines the quantity of monetary aggregates. Remember, in the last chapter we talked about. Yes, the Fed. The Fed determines the total quantity supplied of money. And the Fed will not determine the total amount of liquid assets in the economy by looking at the interest rate, because interest rate is not the determinant for money supplied in our economy. So at any given point of time, we believe the interest rate will have no relationship with the money supplied. And since the money supply will always be given at a particular level and determined by the Fed, and we basically say the money supply of the economy is basically just fixed in our model. Well, combining the two, we will find this one very interesting point right here. So with the money supply demand defined in the models, now we can find these interceptions of the supply and demand model, which is this point right here, 3.5%. So again, if you want to actually understand why this is an equilibrium in the money markets, well, the easier way to do it is to ask the questions. How comes we don't have a higher interest rates in the economy? Is this interest rates going to provide an equilibrium conditions? Is there no tendency to make change? And obviously, well, the question is, if we have a higher interest rates than what we say here, the equilibrium interest rate 3.5%, how is the economy will react? So at a higher interest rate, obviously, we see that the money supplies will not be changing at all. However, the only thing changed in our economy is the quantity of liquid assets change with this interest rate. Well, at this high interest rate, because people do not want to keep the liquid assets, they want to basically save the money in the economy so that they can earn more in returns in the future. So that's why people will not be interested to keep this liquid assets in the economy. So they don't want to keep that much of cash in the pockets. They want to save the money into some forms of non-liquid assets so that they can earn interest payment in the future. Well, because of that reasons, well, you are going to expect to see a lot of people keep saving the money, saving the money. However, we can think about the operations of the bank. When bank actually seeing this high level of savings, but they are trying to kick it out to earn profits, right? They want to loan this money out for profits. Since the interest rate is so high, well, no firms and businesses, they are actually interested to borrow the money because the cost for borrowing is so high. And in this case, obviously, the bank will be flooded with all these liquid assets and they don't know how to deal with it. Well, the easy way for the bank to deal with this problem here, obviously, is to attract more firms and businesses to borrow the funding so that they can at least kick some of this funding out so that they can actually make a profit. Well, in this case, obviously, there is a tendency for the interest rate to slowly go down. When the interest rate starts to go down, when the banks start offering a lower interest rates to the firm and businesses to borrow, then obviously we can actually get the economy balance out the quantity of fundings in the economy. So in the reverse, if we have an interest rate that's lower than the equilibrium, you will find the economy to have a very high demand for this liquid assets. So as you can see, the quantity of money supply will not change with the interest rate, but the quantity demand for money will change. So with the lower interest rates, people will not be interested to save the money into a non-liquid form to earn interest payments because the cost for holding the money it's very, very low. So majority of the people will keep the assets into a liquid form. So this high quantity demands of money will drive banks running short of cash to make a loan or borrowing to the firms and businesses. So in this case, well, bank will have to figure out how to keep those liquid assets into a financial institutions. So those banks and maybe the financial institutions will have to start thinking about like attracting people to keep their money into a long-term non-liquid forms of saving account or assets. So with the low interest rates, what happens is banks or maybe other financial institutions will keep pushing up the interest rates to attract people to keep the funding into a non-liquid forms, so that we can make a balance of the quantity of money in the economy. So as a result, there is a direction change. So the interest rate will keep going up until some point it will stop. So ultimately, the intuitive idea here is with the high interest rates, well, the non-liquid assets demand is greater than the quantity supplied of the money, and that's why the interest rate will slowly decreasing. And when the lower interest rates basically in the economy, the non-liquid assets demanded is higher than the quantity being supplied in the economy, and that's why it's driving the interest rates up and slowly moving towards to this equilibriums in the money markets. So we know how the interest rate is being determined in the money markets, and after this, well, everything starts to combine and make sense. So for instance, if we think about how the Fed's actually making a change of the interest rates in the economy, you can think about how they use the monetary policy tools, such as the open market purchase, decreasing the discount rates, or maybe decreasing the required reserve ratios in the economy. So either one of the three policy tools can actually increase the money supply in the economy, as we discussed in the previous chapter. So when the money supplies increase, when the banks start getting this additional flexibility to make loans in the economy, well, more money will be injected in the economy. And as the money supply shift to the right or increase in money supplies, you will find that there is a new equilibrium of interest rates. And this is basically how the Federal Reserve actually make change of the interest rates in the economy. On the other hand, if the Fed reverse those policy tools, let's say using an open market sales, or increasing the discount rates, or maybe increasing the required reserve ratios, what happened is the Fed is tightening the bank or maybe the financial institutions' liquid assets, and that's why the money supplies in the economy will fall. And as the money supply decrease, well, we'll reach out to a new equilibrium interest rate, and that's basically how the interest rate will goes up in the economy. Well, for now, I think we have studied two different models that has the interest rates represented in the models. Well, one is the loanable fund markets that we study in the previous chapter. The loanable fund markets basically describes the loaning and borrowing process in the economy. And we also study the money market in this chapter that talks about how people making the choice to hold the assets into a liquid forms or non-liquid forms depends on the interest rates as a opportunity cost. So either one way or the other, obviously, those interest rates are linked together, but they're not exactly the same. And we call this the tail of two interest rates in the economy. So in brief, we basically refer the long run real interest rates that we described in the loanable fund market is the one that we actually look into in the interest rates in the long run. The main reason is because when firms and businesses are borrowing the money from the financial markets, they are usually looking for these investments for a long term, and usually they will not borrow the money for one day and return the money in the next day. So most of the decisions made by the firm and businesses when they get into the loanable fund markets, they are looking to pay off the interest payments in the long term. And for people who are basically making a loan for the firms and businesses or buying a stock of the firms and businesses, they are usually looking for a long-term returns in the future. So that's why they care about the long-term interest rates instead of the short-term interest rates. On the other hand, the money markets is the one that we described where people are usually looking for a short-term nominal interest rates to determine whether they should hold their assets in the liquid forms or non-liquid forms in the short terms. So people in this money market, they usually be very short-sighted. They only look at the current conditions of the economy to determine whether they should save the assets into a liquid forms or non-liquid forms. Should they hold in cash or should they hold the assets in a non-liquid assets form, such as CD accounts, savings, or maybe buying a treasury bonds. However, in the United States, the short-term nominal interest rate and the long-term real interest rates are usually very closely related to each other, and they move in the same directions in most cases. Well, in order to understand a little bit more about the short-term nominal interest rates, we have to define what is a short-term interest rate. So the easier way to think about the short-term interest rate is to understand the fundamental idea of federal fund rates. So as we talked about last chapter, we actually discover when bank got into a trouble of bank runs, usually they can actually go into the economy and start finding another bank and borrow the money from them. And of course, this borrowing process is not free. Well, it involves some cost that Bank A has to pay. Well, since Bank A is the one who borrowed the money from Bank B should also be getting some benefits. And obviously, because they are both banks and they know how they run the businesses, well, Bank A is going to pay an interest rate to Bank B to borrow this funding. Well, when the interest is charged on this money of borrowing, and obviously interest rate is becoming the benefits for Bank B to receive and Bank A to pay. And this interest rate has a very special name. We call this the federal fund rate. Usually the federal fund rates refer to a overnight borrowing or maybe a borrowing that involved with a very, very short, extremely short periods of time within the bank business. To be a little bit more accurate, the federal fund rate is basically determined in a market called the federal fund market. But fortunately, we do not need to know the details about this federal fund market because only bank can borrow or lend money in the federal fund markets. Federal fund rate is not directly relevant to any of us. Households or firms will not be able to see the federal fund rates or will not be getting the federal fund rates. Only the banks within the industry will actually use this federal fund rates for lending and borrowing. Well, any change of the federal fund rates usually will result in the change of the short-term nominal interest rates or maybe even the long-run real interest rates. However, the effect of the change of federal fund rates usually has a greater effect on the short-term interest rates than the long-run interest rates. If we take a look at the actions taken by the Feds, in this graph, we are basically representing the targets of federal fund rates set by the Feds and the actual federal fund rates in the federal fund markets. Well, as you can see, well, the orange line basically represents the targets set by the Feds. The green line basically refer to the actual federal fund rates in the federal fund markets set by the banks. Well, you can almost see how effective the policy is because every time when the Fed actually setting a federal fund rate and making change of the money supply in the economy, the bank immediately take actions and the bank immediately actually forcing the federal fund rate markets equilibrium interest rates to exactly the target rate. And one interesting phenomenon that we've seen in the year of 2009 is that the Fed's actually driving the target federal fund rates to zero. But as you can see, well, the actual federal fund rate can never be reaching to zero. And that brings up a problems, which we are going to discuss in the next videos. So how is the change of federal fund rate will affect the aggregate demands? So ultimately, we are not only just interested in the money market, we are also interested in how the change of the money market's interest rates will affect the economy functions. So there are three different channels how the money markets or change in interest rates will affect the aggregate demands in our ADAS models. So number one, consumptions will be affected. When a higher interest rate is being set in the economy, well, people will start facing a high interest rate to buy some durable goods like computers, cars, refrigerators, and stuff like that. And that means when the interest rate goes up, the consumptions on these durable goods will decrease because people will have to face a higher cost to pay off the loans on these durable goods. However, when a lower interest rate is set in the economy, obviously it will boost the purchase of the durable goods in the economy. Investments will also be affected. With a lower interest rate, firms and businesses will face a lower cost to borrow money to invest for the future productions. So in this case, when a lower interest rate is set in the money markets, firms and businesses will have a lower cost, and that's why they will spend more money in the economy. Net exports will also be affected. When a lower interest rate is basically forms in the domestic markets, foreign businesses or foreign investor will not be interested to demand the US dollar or maybe the domestic currency, which drive the currency downs or the exchange rate of the currency downs in the international world. Well, as the values of a dollar go down, that means it's cheaper for other foreign countries to buy goods from the United States because, well, relatively, the currency will be buying more goods from the US using the exchange rate. And that's why the US exports will increase. And at the same time, because it's more expensive relatively for us to buy from other countries, so our import will decrease. So therefore, the net exports will actually increase overall when we're facing a lower interest rate. So in conclusions, obviously, when the interest rate goes down, seems like consumptions, investments, and net export will all increase. And when the interest rate goes up, consumptions, investment, and net export will all decrease in the economy. So we can actually refer how the aggregate expenditures change will affect our aggregate demand models. So in general, you can think about if we actually having a negative demand chart, we're moving from point A to point B in these models, where the economy is officially into a recession. How can a monetary policy will helps to reduce these burdens of the economy? Well, when the aggregate demand curve, it's actually intersecting the short-run aggregate supply curve, and obviously, it's below the potential GDP. We know the economy is in recessions. In this case, we can actually have the Fed to carry out what they call the expansionary monetary policy. So the expansionary monetary policy basically is a policy that we use, or the Fed use, to actually increase the money supply and decreasing the interest rates so that we can boost the consumptions, investment spending, and net exports in the economy so that we can shift the aggregate demands to the right. So ultimately, we are trying to use the policy tools that exist, like, for example, we talk about changing the discount rate, or maybe making change of the deposit required ratios, or maybe making change of the open market purchase so that we can actually boost the money supplies in the money markets that drive the lower interest rates in order to boost all these expenditures in the economy. On the other hand, when the economy is facing a high inflation period, Let's say in this example, we are having a short-run equilibrium at point B because of the high inflations being driven by the positive demand shocks. The Fed can also reduce the burden of this unstable prices or maybe high inflations by using what we call a contractionary monetary policy. So contractionary monetary policy is a policy that uses the monetary policy tools to decrease the money supply in the economy in order to increase the interest rates in the money markets so that consumptions, investment spending, and also net export will reduce so that the aggregate demand curve will slowly shifting back to the left to reduce the unexpected inflations in the economy. So very similar to what we discussed in the fiscal policy. However, it's very different mechanisms that we study here. So it's not just by the change of the federal spending or maybe tax policy. Here we are actually using a very indirect way to affect the money markets by using the change of money supplied in order to affect the aggregate expenditures in the economy, which is consumptions, investment spending, and net exports. Well, there's sections in the textbook that give you a very nice uh, uh, policy map that kind of explain to you how the expansionary policy or contractionary policy works in a monetary policy discussions. So please make use of this summary, this flow maps, so that you can actually get a better sense of how the Federal Reserve in the United States actually carrying out their monetary policy to help reducing the fluctuations of the business cycles in the short runs. So that's basically the overall policy tools explanations. In the next videos, we are going to talk about how the policy will affect the economy and what's the limitations that we face during the Great Recession in 2009. And we'll talk about how the policy targets actually has changed in the recent years. So I will see you guys in the next videos.